So Martin, digital is quite a buzzword today in business, but it means many things to many different people. Mm-hmm. What does it mean to you in the context of business?
Well, if you look at it in the context of our business, it probably means, five things. It's what we refer to as the five-legged stool of Google. I mean, you'd start off in desktop search, then you'd migrate to display, video, social and mobile. So there are those five things. So that's the literal explanation. The philosophical explanation, if there is one, if you were trying to describe what Sergey and Larry were basically about, or Mark Zuckerberg and Sheryl Sandberg or others, I mean, they're basically in the disintermediation business. At the end of the day, they're trying to provide, I think, products and services for you or I as consumers at cheaper prices. So they're basically squeezing the supply chain and disintermediating or disrupting established businesses. And they disrupt them broadly, and I'm talking about not Google or Facebook, but generally. They disrupt them in three ways. Firstly, they disrupt or disintermediate the traditional business model. Secondly, they're evaluated it by VCs and investors in totally different ways who look at the top line or the potential top line, because sometimes these companies don't have revenues to speak of. They don't look at margins or cash flow, which they do in the case of us, or if PwC was public, PwC. And last but not least, they are very attractive destinations for talent. So talent is absorbed or attracted into these new, buzzy, less bureaucratic, more technological operations. So digital means there's something extremely literal. It's now 36% of our business. The industry weighting is about 20%. In other words, clients invest about 20% of budgets on digital. So we're about twice the market weight. But we also know that consumers spend, for example, Mary Meeker estimates in the US about 45% of their time online or with mobile. So therefore, although the industry has moved to 20% and we're at 36%, we're still both underweight, even though we're double the market.
How has WPP embraced digital? What have been the key changes?
Well, I think, I don't know about key changes. The key things, I was at a retail symposium this morning and a sort of similar question. And I had some people in our company at the store, which is our retail consultancy business, basically. And I said, they had three things for me. And I thought about it as I was going there in the car. And I think the first and most important thing is sort of attitudinal. I mean, you've got to get people out of the legacy habits. And why is it that the industry is at 20% and consumers are at 45%? That doesn't make any sense at all. Part of it is because we still overinvest in newspapers and magazines, the felling trees and distributing newsprint. And the other is we haven't invested enough in internet and mobile. So attitude is terribly important. So you have to sort of galvanize if that's the right way. And you have to encourage people to do cannibalistic things. The old saying about if you don't eat your children, somebody else might. That was certainly the case in 2001, 2002. There was a big discussion about newspapers, for example, having digital newspapers, because if they didn't, somebody would come along and attack traditional newspapers in that way. So attitude is terribly important. I would say understanding the importance of data, which is out of our 19 billion, or actually if you include our associates, $21 billion of revenue last year. 5 billion is Kantar, which is what we call data investment management. And that's clients coming to us for consumer insight. And so understanding data in a digital world is critically important, because all those five areas that I mentioned give you unique insights in consumer behavior with the data that they generate. And then I would say the third thing that's really important is experimentation. So, at the moment, for example, we have an investment in Vice.com, which is the subject of a lot of interest. It was an investment we made many, many years ago at quite a small level. Then News Corp came in subsequently at a higher level. And of course, now people are talking about Time Warner and others having a look at it at a wholly different level. So if you think about a similar situation with Fullscreen, where there are at least 2 or 3 people looking at that. So it's investing, and early examples of that would be our investment in Omniture, which was web analytics, which Adobe absorbed, in my view, too early. And then Buddy Media, which Salesforce.com absorbed, again, too early from our purposes, because these are training vehicles. So I would say experimenting as a sort of strategic VC, not somebody who's necessarily interested in churning the investment or selling the investment in a short period of time, whether it be 2, 3, 4, 5 years. But we are strategic. And, you know, we will pay higher prices and higher entry premia for companies that we think will help us strategically, training our people, like the case of web analytics and Facebook, and developing our people, and of course, obviously, developing an understanding of the area. So I would say attitude, data, and then a willingness to experiment. I mean, I think a strategic PE, or it's more actually strategic VC. I mean, historically, we focus more on late-stage investments, but we've now set up WPP Ventures on the West Coast with one of the principals of AKQA. Tom Petticarrier is leading that, and we're making early-stage investments as well. But you have to experiment, and there's no, I mean, for example, better just treat it in a abstract fashion, but I had lunch with a client today who was talking about a very successful online operation which was undermining, disrupting, or disintermediating their business. And we were talking about it, and I said, you know, if I had seen that actually at Allen & Company, that company in Sun Valley, on these elevator pitches they do on the Saturday morning of Sun Valley, where I'd seen that company 4 or 5 years ago. That doesn't affect us, but it affects this particular industry. And my view was that he should have made an investment in that company or something like it. So you have to experiment.
So Martin, you've talked about the need to experiment. How do you manage to do that in a world where you are reporting on a quarterly basis?
Well, with difficulty is the answer, but you know, our business is a fairly rapid payoff business because the investment we make is in human capital. So of the $19 billion or $21 billion of revenue, there's about 12 billion that's being invested in people. And just to show you how paltry the capital investment is, we only invest about $450 million and the net capital investment is very small when you take off the depreciation flow. So we're a human capital investment business, so the payoffs on human capital are very short term, in the sense that if you'll know whether somebody's going to work or not within. It's very rare they're slow burns. I mean, you know, within. I mean, a lot of them come in with what I call the Jesus Christ or Holy Moses aura over them. You know, they are the hero or heroine who's going to change a bad dynamic or further improve a good dynamic, and within 3 months or 6 months, you know, they're not the flavour du jour anymore. But the simple fact is that we invest in people, and the payoffs on people are fairly rapid. You know where you are. So the fact that we're reporting quarterly is not that much of an issue. I would say the quarterly reporting encourages you to do more capital transactions. By that I mean that it makes the option of acquisition more attractive than building, which I think is a mistake, right? But so what we would tend to do is, in most of these cases, you know, when I'm saying experiment, we would tend to buy rather than build, because building is a drag on your P&L. And in fact, I've had clients actually say to me, would I go and talk to senior management? There have been 3 occasions, because they think they can't get their financial function to understand that from a cash flow point of view, building is better than going out and paying massive premiums for internet companies, and particularly with internet companies. And one other thing, in an era of cheap money, you know, we borrowed 30-year money at 5.6% gross last year, and we could do it today at 5.1%, which is 3% net or thereabouts. So you can buy a company at 33 times earnings and not feel the heat, at least in theory. In an era of cheap money, which won't last forever, but particularly now, you know, price multiples are being bid up. You know, one company we saw just recently in the last 24 hours, which is in what I would call a very mundane area, which years ago I think we would probably pay 5 times EBITDA, or 6 times, or 7 times, or maybe even 8 times, went at 12.5, 13.5 times, with 2 PE companies selling one to the other. So it's sardines for buying and selling, not for eating. So, you know, the world is a very strange place.
And where you are placing the bets, particularly inorganically, as you say, to avoid the drag on the P&L, Have you had to create a culture of being able to kill off quickly if it isn't working?
Well, acquisition is interesting. I said yesterday when we were talking about some opportunities in WPP at our board meeting, in our business, because of the nature of the investment, if something isn't working, it's not necessarily because, and in most cases, almost all cases, not because the business is bad, because we're in actually quite a good area which is growing. I mean, if I look at the last 28 years WPP has been in existence, we've just had 3 recessions, 91-2, 2001-2, and 2009. So out of 28 years, it's not actually 5 years, but let's say it's 3 or 4 years, where the nominal spending in the industry and our like-for-like has been negative. So it really is quite interesting. So we're in the right place, and it's a service business is very difficult to fix. Now, and you fix it by not putting a for sale sign over it, you fix it by changing the management, because the management's not good enough. Because it's amazing. I mean, it sounds trite to say it, but if you get the right person in the right place, it all works. Okay, and that's what you basically have to do. Now, as you move more and more into technology, obviously, if the technology is a disaster, you would cut it. You would just take your lumps and move on. But in our, we're not really in the technology business. We're in the application of technology business. We apply technology like Xaxis, which is our digital media planning and buying operation, or buying operation, is really the application of other people's technology. And so, we can't hope to compete with Google at 400 billion in market cap when we're at close to 30. I mean, I wish we were 400 billion, but we can't do that. So, and Alibaba will go public in a few weeks' time at probably around a $200 billion valuation. So there are some big mothers out there. Apple may look as though it's the most valuable company in the world, but probably Google, you strip out the cash, Google probably has got better enterprise value or market value. So I think it's unusual for us to sort of cut it quick. The other thing about people generally is they never take unpleasant action quickly. So I'm just as guilty as anybody else. I mean, you don't like to admit you made a mistake, but more importantly, you don't like to do unpleasant things. Nobody likes to do unpleasant things. And shutting stuff down is unpleasant. And you always give people, and I'm just as guilty as anybody else, too much time. I mean, even if intuitively you feel it's wrong, you always delay the evil day.